And we're back at it again on this fresh Monday morning, and we're going to jump in and see what I said on Friday and what played out over the weekend. Right now, I am considering getting in long because of this double bottom and just running up into this area of congestion here. And hopefully what will happen if we do see a bounce up into this area is that we'll come back and settle onto this 89 level. If that happens, I think it's a good short-term sign. If we can't break back above this 89 level and just consolidate in here, we may see a bit more downward move. So the chart that you can see in front of you is where we left it off on Friday. And I said that I might get into a trade long in this area here and run it up into this area of congestion. And obviously the reason that I say that is the same reason that I harp on about all the time, is if I don't have a longer term bias and I get into a trade, I want to run it up into the next area that could cause any trouble. And for us here, that area is obviously the next area on the chart where there's been a bit of congestion, which is here. So if we play it out, we can see what happened. So the market just immediately shot straight up and we got very close to this area, but not quite into the area of congestion, and then started to pull back again. And then we dropped. And at that point, you could be starting to get a bit worried because maybe the sellers were front running this area and it started to drop off. But I did hold on here and we started to turn around and we made it up exactly into this area of congestion. Keep playing it out and we just stalled in this area. We started to try and make it higher but couldn't, got rejected and pulled back into this area. And then we make another attempt at going up again, but still can't make it, and then we just start to plunge. And then we make it all the way back down into this area, which is close to the lows. We nearly double bottomed this area. But we didn't quite make a new bottom here, which is indicative that there's still quite a lot of buying involved. We couldn't make a double bottom, so we couldn't quite get down into that area. The sellers just didn't have enough momentum to pull us down that far, and the buyers were just piling back into the market to hold us there and then try and curve us back around to the upside. So just jumping back into this trade idea that I had on Friday, I did end up taking this trade and I got out here at 9,340-ish. And it's a really good example here of why I always say that we need to just get out of the first trouble area, because a lot of people would get in here and be like, okay, I'm just going to hold this. I'm just going to run it long and run it back up into the 12,000 area or something like that. Potentially you could do that and it might end up being profitable. But when you're not confident in that idea that it's going to run that far, I'd rather get in the market, get out of it again, and just take some money off the table. Yes, maybe it continues to plow straight through and I miss the move. But this is a game of probabilities. What's the chances that if I had this exact setup 100,000 times, it would run up to 12K enough of the time to make it worth holding on to overall? I mean, I'm not confident that it would be enough, because the times that it doesn't run up, it's probably going to run up into this area, come back down, and I'll break even or probably even take a loss. And then the small percentage of the time that it does run up to 12K, you have to balance those out and see, is it worth it? Is that risk to reward worth holding on to the trade? If you think it is, then go for it. Hold on to that trade. But I need a lot of conviction to want to do that. Otherwise, I'm just going to get in and get out. So I got in here, run it straight into this area, got out because I wasn't confident, and then we stalled in this exact area. We tried to move higher, we just couldn't. So even if you were trying to run it and we try to get higher and we just get pulled straight back, that's a warning sign. We tried again, can't make quite as high, and then get pulled back. These are just warning signs that are telling you the market is struggling in this area. So that would be a good place to get out if you did want to hold it, but I was out way before out here. And then we just plunged all the way back down nearly to these lows. But then the thing is, when this sort of thing happens, is that I've got in here, I've got out here, I've taken some money off the table, then the market comes plunging down, but we can't quite make a low. So this is now another good area where I can start looking at the price action and see if there's another possibility of getting into a second long trade in pretty much the same area that I got the first trade. In this case, I didn't find a trade here, but it is the sort of thing you could do. But if we just play it out from here and see what happens, we can see that from that low, we did actually end up moving higher. So if you did manage to find a trade in that area, you just got a second trade in the same area that you got your first one in, and both were profitable. So you've basically doubled your money on the same trade idea effectively. And here we go. We did end up shooting up straight through here. We broke these highs, which was a good sign. So at this point, I was looking for a trade if we could stay above this area. So if I just put the line on here, we just drag that down. We had this area here. So we had some lows in here, we had some highs here, and then this is the area that we double topped in. And we broke very cleanly through on this candle. So I was looking for us to hold above this area and then round back and touch this point of support, and that I would get in long. And if we play it out, we can see that's exactly what happened on this candle. We came down, pinged this area, and then immediately formed a bit of a hammer. We ended up coming further down on the next few candles, and we've just sort of consolidated. And I did actually get into the trade here, so I got in on this green line as we retouched here. I was in profit for a bit. We've just sort of chopped around, and it came down, pulled me down into a bit of drawdown in this area, but I just held on, and we are starting to move upwards. So this is real time now. So a few hours ago we had this nice thrust upwards, but again we're stalling here. At this point I've got to ask myself, why aren't we going? Because we've had this nice area here of resistance, we broke cleanly through, rounded back, we retested it as support, and then we've shot up on this candle, but there doesn't seem to be a huge amount of momentum behind me in this trade. So quite often that makes me concerned. I don't want to see all of this chop that I had to sit through. I want it to come, touch my point, and then just take off, because that validates that that is a very solid area and the trade idea was very good. But in this case, we chopped a lot and we have made a bit of a thrust through, but it's a bit lackluster overall. So I am actually thinking of closing this trade now and not continuing. And we can see back here that we have a bit of a consolidation range and we haven't been able to break above that. And we've got all this chop and stuff. I'm just not that confident in this trade. So I am probably going to close this out. And if we do end up moving much higher, fair enough, I missed all of that action and I'll just look for another entry. But I would rather take a small profit when I'm not confident than watch the market come plunging back on me and have to scratch the trade, or even worse, take a loser. So I'm happy with the small winner. So that's my sort of reasoning behind that. And I know a lot of people get hopeful in these situations where they're like, but it's up a bit, I'm in profit. Maybe, hopefully, it can just push a bit further and we can break through this area, and then I'm home free. I've made loads of money then. But that's just hope. You're, again, trying to impose your own will on the market. You're hoping that would happen, but the chart is trying to tell you a different story. The chart's saying, I'm trying really hard here to get through this area, but it's not quite working for me. And it's in those instances that you need to get out. So, for example, in this area here, we came down, and then if you had a trade set up, say, for example, this isn't a good example, but let's say this was an area of resistance up here that we'd bounced off, we'd made some highs here, and then we broke through, we came down, we retested. It touched here, and then it just immediately shot away. That's telling me a ton of buyers are coming in because that's a good area. They're just plowing in, and we immediately started to put in some upward candles. And then we sort of went sideways a little bit, and then we just took off. That's what I'm looking for. I'm looking for that quick move that's telling me that the area that I'm looking to trade in has a ton of people coming into the market on the same side as me, and we're just going. We're not consolidating. But here, the opposite happened. We're just chopping around, where I thought that this would be a nice level for people to start coming in as buyers because we'd broken through. But it's not been the case, and we've just chopped. Eventually, they have come in. But why didn't they come in earlier? That's the question that I'm asking. So that makes me a bit skeptical that this might just be a bit of a fake out or something, and we're going to fly up and then just come fly back down. So I'd rather Just remove the doubt from the table, take the small profit and move on to the next trade. So anyway, that's enough about that. So now let's hop onto the daily chart and take a look at where we are in the context of the bigger move and think about some ideas of how the market could play out over the next few days. So here we are on the daily. So something else I've been thinking about in regards to the log versus linear trend line idea is that we've got these log and linear trend lines moving downwards above the market. But what if we drew both of them below the market as well and see where we're bounded from the underside? So right now we're on linear. So if I just grab the trend tool and we can start to draw up these lows. So we take the low from here, we match it to that low, we continue through, and we can see that we get a nice touch on 3 points here. We've got a touch, a touch, a touch. So I'll just change this to red to match the other linear line, so we're consistent. And we'll flip over to log mode, and we'll do the same thing, and we'll match up some lines. So this time, I see this low here, we could easily match those up. But then this low doesn't really match with that. But if we continue past through this low, we see we've got a match over here. So we could say that this was just a plunge through, a fake out through the trend line and back up again, because we didn't spend any time below it. So if I match from this low here and go all the way through here, match that low there, and follow it through, we get quite a nice line. So we'll just change this to yellow to match the other log one. So we get from here and we get some nice touches. So we just have this fake out and then we get some nice touches through. So what's the point of drawing these? So if we zoom in, we now have this sort of triangle that's bounding the market. So we're in log mode right now. So we have this upward trend line that we're below right now, and we're above this trend line. So that converges on this point in here. That's a really good area to be looking. So we might hover in between these areas and then start to move upwards. And that sort of ties back in with this fractal idea where we could come up and touch this upper trend line, which would match the attempt to move higher after this double top, and then get rejected from that trend line and move down. And then we could move down to touch this lower trend line, and that would coincide with being close to the convergence of these lines, and that's the point we break up. So drawing that on again, we'd come up here, round, touch the bottom of this line here, round, and that's the point that we break. And I think that's tying in some ideas where we have these two trend lines converging and this fractal idea that play out, and they merge very harmoniously. So that's definitely something to be looking at. Not to mention that we do round here and have this touch of this trend line at this previous resistance point. So at a daily level, it's also the convergence of that level with this trend line, and it plays into this larger fractal pattern. So there's quite a few things playing into that. So that's definitely my main thought as to how the market will play out. But obviously I'm reacting to all new data that's coming in, and maybe I'll abandon this idea tomorrow. But for now, I really like this idea of the market playing out in this fashion. So definitely keep an eye on that. But we can just flick over onto the linear line and take a look at that. So that's slightly different in that we're now above this linear line, but we could ride it down towards the trend line down here. So we could stay above this and just use that as support on the way down. And then once we find the support of the convergence of those two lines, that's when we start to curve around. And that again could still play into this idea of this fractal, where we come up and then we come back down, we round round, and if we just lengthen out this trend line, we could come slightly further than what we have drawn on based on the log movements. We come further and touch round here where these two linear lines converge, and then round and move upwards. So those are two scenarios that are kind of playing out in harmony, the linear scenario and the log scenario. The only difference being that the linear scenario takes us a little bit lower than the log scenario does. But I don't think that's a huge thing. And it's interesting that these two opposing ideas that a lot of people see as the linear versus log, and it's always versus, it's never with. But here we could see that they could both potentially play out in harmony with this bigger idea of the fractal that's playing out. So we'll just start talking about some general ideas. So a common indicator that a lot of people tend to use, including big institutional names, is the 200-day moving average, or 200 period, depending on what time frame you're on, but typically it's used on a daily, and it's a really good indication of general market trend. So if we're above that 200-day moving average, we're in a bullish trend. If we're below it, we're in a bearish trend. That's the overall idea behind that. And what ends up happening, because so many people are watching this 200-day moving average as a sign of being bullish or bearish, what ends up happening is that 200-day moving average is really strong support and resistance. And if we put that onto the daily chart here for Bitcoin, and we zoom out, we can see that all through this move, we've never really been below the 200-day moving average until we had this plunge down here. But for the most part, it acted as support, and we came up, and we've always been above it. We did break through it here, and if you go back to the how I called the bottom video, you'll know why we made that plunge down, and we came up, we remained above it, and then we're coming back into this area as we're plunging, and we managed to find some support on it. Yes, we did slightly break through, but we were in the rough area of that 200-day moving average when we started to curve around and see some upward action again. So that's something that you should keep in mind over the next coming weeks and months, is how are we in relation to the 200-day moving average? Because historically, it's been a very good indicator for the Bitcoin support resistance areas. If we come into that area, it tends to hold some solid support, and it tends to make for good buying opportunities. So that's not to say that as soon as we touch the 200-day moving average, you should buy, because if you had done that here, you likely get stopped out as we plunge lower. But we eventually find support. But it's a good ballpark estimation that we're in the vicinity of the 200-day moving average. Now you can start looking for those long entries. That's the idea. And in this case, there were some good entries long, as I've just explained, and I took them. Sometimes you find long entries and there's higher time frame signals that are going against you, that are saying that, no, this is a short entry, or this is an area you don't want to be trading in, or whatever. But sometimes, like in this example, you have higher time frame confluence on a setup that you find on the hourly. And the higher time frame confluence here was obviously this general support zone that we had in the 9,000 area, and the 200-day moving average curving round and finding support there. So when you've got those confluence on the higher time frame and you see a setup on the hourly or something, or the 4 hourly, or whatever time frame you're trading, that's a much better setup, a much higher probability setup for you than if you were to just randomly take entries. And that's something that a lot of newer traders tend to struggle with, I think, that they just fixate on the lower time frames because you find more setups on the lower time frames, and if I take more trades, I will make more money. That's the general thought process that they have. And you can see where it's coming from, but the problem is there's less data that goes into every candle on the lower time frames. So it's less meaningful data because there's less of it. It's a smaller sample size, and anybody who knows anything about statistics knows that the larger your sample size, the more valid the data is. The more valid insight you can get into the information when the data set is bigger. So the higher time frames are just better information. There is more trade data packed into every candle, so there is more information for you to make decisions on. So you might see a pattern on the 5 minute and try to take it long, but the 4 hourly, the hourly, the daily, they're all showing bearish signs, but you've just taken a long entry on the 5 minute. And that can be fine if you run it from zone to zone. So you take it from one 5 minute level to the next 5 minute level, might be a perfectly good trade that you could take. And you could take that over the course of several years and you'd be profitable if you were doing that. But the big mistake is you take that entry on the 5 minute and then you start trying to run it onto hourly targets or 4 hourly targets or daily targets. So if I take a 5 minute entry and I have a stop that's valid on the 5 minute. It's really tight on the 5 minute. And I run this into a daily target. So I have a stop of $50 and a target of $2,000. I mean, that's alluring for people, and they think, yes, this is it. This is where I'm going to make the money. And occasionally it might come off, I suppose, but it's not going to be that profitable over the long term, because you're just going to get stopped out, because the higher time frames will always win out. And the bearish signs on the higher time frames are going to want to pull you down, stop you out, and there you go, you've just taken the loss. But then on the flip side of that, you can get really, really tight entries if you've got confluence on the higher time frames and you drop down to the 5 minute, for example. So I occasionally do this where there is a daily setup and I'll drop down onto the hourly to start trying to spot the price action of a good zone to enter into a long trade on the hourly. And when we're getting into the zone in the hourly where I think that we're likely to turn around, there's some nice price action, I'll drop down onto the 5 minute to finesse the entry even further. And then I have this like stack of confluence where I can take the trade with confidence on the 5 minute and a tight stop on the 5 minute and run that trade onto a daily target. And those are the trades that are really going to make you the huge sums of money. So you might have a trade that you hold on to for a month or 2 months, running it through to a daily target of huge amounts of profit, but you had a stop that was tight on the 5 minute. So this is where you might be taking trades throughout the year that make you like a 1-to-1 risk reward, 2-to-1 risk reward, and that's your bread and butter. But the ones that are really going to crush it for you is when you find that really tight entry and you get like 100-to-1 risk to reward. That's ultimately where your profit's going to come. And there are many traders who only try to trade those massive risk to reward trades, because why spend all of your time grafting it out for these 1-to-1, 2-to-1 trades and really fixating on the charts all day when you could wait for that one trade every year, I suppose, and just rip this massive profit, and you've made enough to support yourself. I mean, do nothing all for the rest of the year. Do what you want. Spend your profits, live life, go on holidays, visit friends, do whatever, and then just monitor the charts very briefly every day, and you find that setup, you rip that trade, you get 100-to-1, and that's you for the year. So that's the two sort of opposing views of trading, this long-term view of taking trades and holding them and just trying to really run them up, or taking these shorter-term trades. And I think being good at both is important, because that one trade a year kind of mentality worked really, really well for Bitcoin over the last 2 years. So if you had found a really good setup in mid-2016, you found that really nice entry, you entered with a tight stop, and Bitcoin started moving up. You could have just rode that all the way up from less than $1,000 all the way up to 19 or 20,000 or whatever. And that's just huge profit. You could have went from, say, $500 with a $50 stop and run that all the way up to 19,000. That risk to reward is just obscene. But that's a trade you've held for 18 months or 2 years. But the amount of money you made on that trade is more than enough to make that worth it. But then you get into times like now, where we're not in this crazy exponential run anymore. We're chopping, we're going up and down. And that's where you can't hold for 2 years. I mean, maybe you can. Maybe if you buy now and you can sit through the volatility of moving up and down and going into profit, going into loss, and 2 years from now, you're massively in profit. I mean, you maybe could do that, but it's not a sure thing. You can't guarantee that's going to happen. Nobody can say with absolute certainty that Bitcoin won't go to zero. Anything could happen. I mean, I personally think it's unlikely that it happens, but anything can happen. You have to be ready for that. So when it's chopping around like this, I don't want to get into a trade and just sit on like my hands and do nothing for 18 months. I want to be in and out the market, taking profits off the table on the off chance that something horrible happens. At least I can say I made something during the journey. Obviously, I would make much more if we do go exponential from here and have another exponential run over the next 2 years and make it to over 100K or whatever. But I can't guarantee that's going to happen. And I don't want to be hopeful that that's going to happen and rely on that hope. I want to control my own environment. And the one thing I can control is when I get out the market, get in the market, and just take small profits off the table. I control that. I'm giving myself the best opportunity to survive. Plus, I'm accumulating more Bitcoin over time. So it's like a trade within a trade. It's like this tradeception sort of thing where I'm making more Bitcoin as I trade short term, and then that Bitcoin is then growing long term. So there's this force multiplier between my short-term trades that I'm closing and locking in some Bitcoin profit, but then over time, that Bitcoin is also growing in value against fiat. So it's this force multiplier where there's two layers. There's short-term trades into long-term trades against fiat. So this is all information where I think that it's valid to learn at least the basics of trading as well as the basics of investing and this long-term trade idea. I think this video has went on for way too long today, so I will catch you all tomorrow.